Recording it. Okay, all right. So we were up to the point where when does a check become stale, and it's 15 months after the date of issue, but you wouldn't want to wait 15 months before chasing up people who haven't banked the checks. So really, if it's not presented within 3 months, it's unlikely that it's going to be presented. So at that point, you really need to contact the person, to the payee who you paid the check to, and just see what's going on. If if nothing's happening and it becomes stale, then you just stop the check, you notify the bank, and then you can cancel it in the accounting records, because you've got to balance your trust account. Otherwise, it keeps being carried forward in your reconciliation statements, and you end up with a long list of outstanding checks, and that's not really a good thing to have on an ongoing basis. Okay, how often does the cash book need to be balanced? Basically, it has to be within 15 working days of the end of each month, and that's required by the legal profession regulation 44.3. Larger firms are going to do it more often than that, simply because of the volume of transactions. You then asked, what are the two methods of balancing the cash book? There are two methods. We use the cash book summary method, which is the most common method. And you can see there how it's set out. So what happens is at the end of each month, then the cash receipts and cash payments book are totaled, and then you then do a cash book summary in the form that's shown there. And then what happens is that the opening balance is effectively the closing balance from the previous month. The other way of doing it is the cash book balance method. And I'm only mentioning this so you're aware that there are different ways of doing these things. So this is where the cash book's balanced and the balance is carried forward to the commencement of the next month. And the opening balance is the first entry of the receipts cash book, or if it's the cash book is overdrawn, then the balance will be the first entry in the payments cash book. It's a really messy way. That's why people don't tend to use it. So we use this cash book summary method, and that's the main thing to be working with. So all the examples you see in the problems you've got from me, and also all of the all of the examples that you'll see in the manual that the Law Society produces is this cash book summary method. Okay, we've got Jeff Gallagher as well. Sorry, I just have to write down who attends. Okay, Jeff, if you wouldn't mind just muting your microphone. Thank you. Okay, then you're asked, how often are the cash book entries posted to the trust ledger? And how do you do the posting? Well, look, the importance of the trust ledger is that the cash books themselves, just whether they're the receipts and the payments, they just show you all of the transactions that are happening on the trust account. So it's a whole mixture of clients' transactions. So looking at that, you don't really know what the position of any individual client is. The whole idea of the trust ledger is that it shows you at any point in time what the position is on that particular client's trust account. And that's the whole objective of it. So that if somebody, one of your clients asks you to pay some money, you need to know instantly whether in fact, firstly, the purpose for which they're asking for it to be paid matches with the authority, and secondly, whether you have that amount of money in their particular trust ledger, it's sitting in the trust account to pay whatever it is that's necessary. So you've always got to be very careful with the authorities, what you're entitled to use the money for, because if you end up paying out on a trust account for a purpose that you don't have authority to do, that's going to create a situation where you're going to have to make good that deficiency in the trust account out of the firm's own money. So you've got to be very careful. Okay, so I've given you a bit of a spiel there. So what happens is the individual entries are listed in the cash books, and they're posted to the individual trust ledgers daily. So you need to do it daily so you know exactly where that trust ledger account is at all times for each client. Okay. probably the best way to show how that works is with actual examples, which we've got coming up anyway. So I might just leave it until there. I'll give you some rules there about posting to and from the trust ledger. You can read those when I post this up on the site. So they're fairly straightforward. Okay, the next thing is to actually have a look at problem 18, because this is where we start to get down into the nitty-gritty of some exercises. So if I have a look at problem 18, it says complete the trust account cash book entries and the cash book summary for March and April for Mulligan Solicitors in relation to a conveyance from Collins to Carlos. You are acting for the purchaser, Carlos, who is purchasing 10 Anstead Street, Brisbane from Collins for $200,000. The matter number is 123. The contract has been signed. 10% deposit is being held by Queensland Proprietary Limited, the vendor's real estate agent. So that's not something that's in your trust account. It's in the real estate agent's trust account. Settlement is set down for the 1st of April rather. Assume the receipts start at number 50. Trust account checks start at number 100. Assume all the checks clear within 3 days. Sometimes you might want a check to clear quicker than that, so you can actually pay some money to the bank to speed up the clearing process. It says you should also complete the trust account receipt for the transaction date of the 1st of March and the trust account check but for the transaction date of the 5th of March. Your firm banks with Eastpac Bank, account number, etc. So let's have a look at some of these transactions. So the way I've set them out is to identify firstly the date the transaction occurred and then what the transaction is. And I've given you a column that has the classification so to make it easier for you to know what to do as you get used to these transactions. So the first one is that you receive from Carlos a personal check drawn on Eastpac Bank. Okay, so he banks at the same place as you do for $6,494, which consists of various things. Okay, so this is a receipt of money into the trust account. So some of the questions you have to ask yourself whenever you receive money into the firm is it something that needs to go into the trust account? Is it controlled money? Is it transfer money? What sort of money is it? All the examples we're looking at now are things that go into the trust account. So what you do, if you have a look at the trust account's receipts cash book, you would say on the 1st of March, which is the date of this receipt, you issued a receipt number 50, and it was received as a check. It was a personal check. If it was a bank check, you would write bank check. Since it's a personal check, you just write check. You received it from Carlos. The reason, it's for stamp duty, for search fees, costs and disbursements. It relates to matter number 123 and this purchase of this property. Here's an example where you've got a multi-amount. So this receipt of this $6,494 relates to several items. Now this is important for a couple of reasons. One is that it helps you identify the purposes for which the money was received. So you know that $5,494 worth of it relates to stamp duty. Okay? So that, say for example, in the future, when the property is settled, if for some reason the stamp duty amount was $7,000, somebody was asking you to pay $7,000, you know that the total amount you can pay for stamp duty from the trust account for this particular client is $5,494. So if you issued a trust account check for $7,000, you would be committing a breach of trust. So that's why you need to know the amounts that relate to specific purposes so that you don't breach and make an error and overpay the trust, take money out of the trust account you shouldn't have. In that situation, if $7,000 was called for, you would have to go back to the client and say, we need further monies to be placed in the trust account, or alternatively, we need your authority to be able to use some of the other monies that you've currently got in the trust account to pay this outstanding amount on stamp duty. So that's why these multi-amounts are important, because they tell you what amounts relate to specific items. So you've got the breakdown there for stamp duty, search fees, costs and disbursements. So the amount received then is $6,494, and that is the amount that's deposited. Okay, are you all happy with the basic structure of how you enter a receipt amount into the trust account cash receipts cash book? Is there any problems with that with anybody? Are you okay? If you've got a problem, just raise it, because I'm going fairly quickly. Okay, we'll go on. So the next transaction is on the 5th of March. This time we've got a situation where you're asked to draw a trust account cheque in favour of the Queensland Office of State Revenue for $5,494 to pay the stamp duty on the contract of sale. Okay, now in relation to stamp duty, you've got 3 months from the date of the contract to pay the stamp duty, otherwise penalty provisions come in play. Now in this particular case, it's being asked to be paid 4 days after you receive the amount, so there's no issues like that. But we're looking at the trust account payments cash book now. So the date is the 5th of March. The cheque number that you're issuing is cheque number 100, because you're told in the problem that that's the cheque that where the cheque numbers start. It's paid to the Office of State Revenue. The reason for the payment is stamp duty. The account name relates to Carlos. The matter reference number is 123. The matter description is the purchase of this particular property. The amount of the cheque is $5,494. So the question you need to ask yourself, do you have an authority to pay that amount of $5,494 for the specific purpose of payment of stamp duty in relation to this particular transaction? That should be the question that you ask yourself before you write any cheque to anybody. So what you would do typically is that you would check the client's trust account ledger, and you would know that you have that money there on that specific trust for the purposes of this payment. So you've checked that, you know that that's the case, so you can write the cheque. Okay, we all clear on that? The other thing to note is that that is the last payment for March, so you total up the monthly payments. So the total payments for March were $5,494. The next transaction, we don't need to go through all of these transactions. I'll just go through some of them so that you're clear on the process, because it's pretty repetitive. The next thing that happens is on the 31st of March, we received from Carlos a telegraphic transfer from Eastpac Bank in the sum of $180,000 to pay the balance of the purchase price. Okay, so this is a trust account receipt. So we go back to our trust account receipts cash book. We write 31st of March. We issue receipt number 51. This time it's a telegraphic transfer, so you just need to write the words TT, meaning telegraphic transfer. It's received from Eastpac Bank. The reason, it's the balance of purchase price, account name Carlos, matter number 123, matter description is the purchase of this property. The amount received is $180,000. That's then deposited. That then gives you the total receipts for March of $186,494. Okay, so that is basically what's happening with these various transactions. Okay, now I'm not going to go through all of them. I just wanted to point out one that's got a trick in it, and that is the last transaction. This is the one dated the 10th of the 4th. And this is one that stumped a lot of people when they were trying to answer this question. And it really comes down to that question. You have to ask yourself on each payment, do you have the authority to make the payment in the amount that's requested? So what we're asked to do is to draw a trust account cheque in favour of Mulligan Solicitors for $800 in fees. Okay, so this is a cheque to our general account in payment of our fees. So can we do that? Now we know that originally when money was deposited there were costs and disbursements. There was an amount of $800 put in there. But the trouble we've got is that there's actually not $800 left in the account by the time we get to this transaction. So there's in fact only $650 left. Now the reason for that, this is why it was a tricky question, because when you looked at it originally, you would think, oh, okay, there was $800 there for a specific trust to pay our fees. Well, you should just pay that. But you must check that there's actually money left in that ledger to pay that amount. So the reason why there isn't, you can see there it's explained. So there was an extra $100 paid for a transaction, an extra $50 for a LawPoint transaction. So there were a couple of transactions there which were more expensive than were anticipated by the client when they paid the original amount into the trust account for specific trusts. So that was essentially, those extra amounts were essentially paid out of this $800 that was originally provided for costs and disbursements. They were classified as an additional disbursement. So you had money in the trust account to cover those contingencies. But what happened is that you did then, because you paid extra amounts, it had to be coming off the $800. There was no other way. You've already got the client's permission, authority, because it's you're able to pay it as a disbursement, to use those extra $150 to pay those extra amounts that weren't originally anticipated. So what happened is that the $800 got reduced by $150, okay, which brought it down to the balance left available that could be used to pay solicitors' fees was only $650, not the original $800. If you actually had put $800 in there and paid it to yourself, you've actually committed a breach of the Trust Accounts Act. Trust Accounts parts of the Legal Profession Act, and that's an offence. So you have to be careful to make sure you've got those funds available, and that's the reason for it. Okay, all right. You then were asked to do the cash book summaries. So they're pretty simple to do. It's just the opening balance, add the receipts, less the payments, gives you the cash book balance. So that cash book balance is the balance left after taking into account what happened in relation to receipts and payments. And that's shown for both March and April. The actual trust ledger is shown there now, and all the trust ledger is doing is capturing those payments that were made and also the receipts that were received in relation to this particular client. So this is the ledger that shows you the position of the client at any particular time. This is the ledger you would have consulted in making the decision as to whether you could pay the $800 to yourselves as fees. And you can see there on the line there, just before you were asked to pay $800 to yourself, that you only had $650 left in the trust account ledger for this client. That is the thing that indicates to you that you can't make the $800 payment. So for each of the transactions that that were receipts, they'll be credits in the trust ledger. So remember, we got the original amount of $6,494. You can see there it's listed. It's also listed in terms of the multi-amounts. It shows you the specific trusts that you can make payments on. Then you've got the Office of State Revenue, the first payment of stamp duty. So that's a debit. It's reducing the balance of the trust ledger. That then leaves you $1,000 sitting in the trust ledger. Then you've got the balance of the purchase price. So $180,000 comes in as a credit. So that increases the amount that's in the trust ledger available for distribution. You then distribute it. You then got these payments that you make in relation to registration fees and search fees. You can see there that the search fees were originally anticipated as being $200, but in fact they turned out to be $250. So that counts for $50 that had to be paid from costs and disbursements. And also you had the registration fees. Now, originally you see there was no money there for registration fees. The only place it could come out of was disbursements, costs and disbursements. And that's where it was paid from. So what was left for you as the solicitor to get your costs was $650. Okay, do people see how you get the $650? Because that sometimes really confuses people. So I hope I've explained it well enough that you can see where it's come from. Then you've just got your trust account receipt itself, just the standard format of a receipt. So all the receipt says is receipt number, the date, labeled a trust account receipt, who it's received from, in this case Carlos, the amount, you'd write it in both words and figures. The form of it was a check. If it was cash, you would have written cash. And then it's made out by the person who's actually receiving it into the trust account. Okay. And I've also listed there the detailed requirements of Regulation 34 in relation to receipts, so you understand where these things come from. It's actually important to realise that, you might just issue a receipt, but in fact there's specific rules that tell you what has to be on that receipt. So you need to be familiar with those and make sure that you comply, because if you get audited at some point, then they'll be looking to see that you've done it correctly, that you've issued receipts correctly with the correct information on them. There's another example of a check. I don't need to go through that because we've already done it in the first problem. It's a similar sort of thing. You're just asked to do a check for a specific date and a specific transaction, and that's what it is. All right. Are there any questions in relation to problem 18? I know that was quite quick. Has anybody got any particular questions or problems, confusion about that? Are we all happy? Or if you're not happy, at least you understand how we've got the answer. Okay, everybody's silent. I'll assume that means that you follow that okay. All right. Now we're up to problem 19. So if I just go back, I've just got to go back in here to read problem 19. Just give me a second. I don't know what problem 19 is about. Okay, here we go. Problem 19. So, what adverse consequences may arise, if any, from making a payment from a trust account by a check which is ultimately dishonoured? Okay. Making payment from a trust account by a check which is ultimately dishonoured. So what this is essentially that you've received money into your trust account by check. Okay. What you should do is wait until that check clears, or if you're in a hurry, you would ask for a special clearance so that it speeds up the process. What's happened here is that you've received a check. You've then gone and paid money out of the trust account on the faith that that check is actually going to clear, but it actually is dishonoured. So the money that you assumed was coming into the trust account didn't come, and yet you've paid money out of the trust account. So you've created a deficiency in the trust account because you didn't wait for the check to clear. So the moral of the story is that you never write a check from the trust account against uncleared trust account receipts. And you can see what the consequences of that happen to be. You actually are required to remedy that deficiency from your own personal funds, from the firm's money. So, you can imagine if there's substantial amounts, if this sort of error can be quite costly. So you want to make sure you never do this. And also you can see there that you breach section 249. And you can see there it says that a law practice must hold trust money deposited in the general trust account exclusively for the person on whose behalf it is received. Disperse trust money only after a direction given by the person. So what you've done, in effect, is that you're no longer, because you've paid money out of the trust account that you hadn't received, you're actually paying other clients money out of the trust account. So you're not actually holding trust account funds exclusively for the person on whose behalf it was received. So you actually commit this breach. 50 penalty units, 50 by $110, 5,500 potential fine, quite steep. The law practice must account for the trust account money in the way prescribed by the regulation, etc. So it's really that first part of 249. So what are you left? You're then going to be left in a situation where you're trying to recover the money from whoever defaulted on the check. Not a great position to be in, is it? And you can see there 259, that section, deficiency in the trust account. You must not, without reasonable excuse, cause a deficiency in the trust account or trust account ledger, failure to pay or deliver any trust money. Look at the fine there, 200 penalty units. You know, that's $22,000. It's not to say you'll get fined that maximum amount, but you're going to get fined something. So obviously something you need to avoid in practice. So don't be too hasty in paying out on trust account and paying out the trust account until you've done all the checks as to whether the money is available, it's cleared, and you're paying out on the right for the right purpose. Can't emphasize that enough. Really important. Okay, then we go on to problem 20. So just skipping down so I can read what problem 20 is. What does it say? You notice that money has been removed from the trust account on one of your files, but has been replaced the next day. Okay, alarm bells. Alarm bells should be ringing. That only happens where there is something terribly wrong going on in the firm. It's either fraud or there's some really major problem with your accounting system or processes. Either way, it's bad news. The Law Society auditors have not picked up on the irregularity. That was lucky, perhaps. Do you have an obligation to do anything? Well, what do you think about that? I'll put that down there. What do you think? Let's hear. I've been yabbling enough. Do you have an obligation to do anything?
Yes, the practitioner has obligation to, on becoming aware of the irregularity, he's got to give written notice of the irregularity to the Law Society under Section 260.
Yeah, exactly. You know, this is a bad situation. You don't want to see this happening in practice, because you imagine you're working in a firm and you're, say, a solicitor or an employed solicitor. You see this happening. It's a real problem, isn't it? Because you fear that you're going to lose your job because you're going to point out that something, that there's potential fraud going on. It might be one of the partners doing it. Who knows? But you've got to disclose it. You've got to tell the practitioner, the partners in the firm, and you've got an obligation to the Law Society as well. It's statutory. So you can see here, there's been a breach of Section 249. Funds haven't been held exclusively for a client. Okay. Because money's been removed from the trust account. It means some clients' money is not in the trust account when it should be. Even though it's returned the next day, it doesn't matter. If you don't report it, then, there's 50 penalty unit fines, and you've got 260 again. Requires a legal practitioner associate of a law practice to give written notice to the Law Society as soon as practical, as soon as you become aware of this. Okay. So if you're in a second year of practice, you're going to be an employed solicitor. So you have to report this. There's no two ways about it. Okay. All right. That brings us to problem 21. Now, problem 21 has got a bit in it, and we'll work our way through this. So you are a solicitor employed by Mulligan Solicitors Brisbane. Draw up the cash receipts book, cash payments book, trust ledgers, control money movements record, bank reconciliation statement. Now that always, the bank reconciliation statement always creates problems for students. So we'll have a look at that. Check numbers start at 001. Checks start at 201. Receipts at 001. Checks 201. Assume everything clears in 3 days. Solicitor handling each file is Peter Handel. Responsible partner is Julia Phelps. And then you've got all the transactions. So what you've got, you're also given a bank statement. Okay, so you know what the balance is in the bank account at particular times. Sometimes you'll see little tricks in these questions where, for example, the bank charges you a bank fee. Banks don't charge fees in relation to trust accounts. The reason they don't charge fees is because they don't pay any interest on these accounts. So trust accounts are a pretty good deal for a bank. They effectively get a whole pile of money sitting in there on which they can use to lend out to other people, and they don't have to pay interest on it. The quid pro quo for that is that they don't charge bank fees. If they do, then you have to recover that back. And we'll probably see some of that in here. So we've got the bank statement, and then you can see in the solution I've given you the actual trust account cash receipts book and the cash payments book. So what we'll do is we'll go through some of these transactions, not all of them, and so that you make sure you're comfortable with the process. So we'll just start off on the 1st to the 5th. We've got a transaction. It's a purchase. Knowles is purchasing something from Mudrake Proprietary Limited, some industrial estate property. Transaction 123. You receive from Knowles a bank cheque drawn on Eastpac Bank for $600,000, so you automatically know this is a trust receipt situation. This is the deposit. Normally it's held by the real estate agent, but given the amount involved, the client insists that it goes into the solicitor's trust account. They perceive that as more prudent. Can happen, it's rare, but that's what happens. So basically you've got $600,000 coming into the trust account. So on that date, the date for the 1st of the 5th, you've got the issuing of a receipt, 001, it's a cheque. It's Knowles, it's deposit, it's in relation to this purchase of an industrial estate, it's amount of $600,000. Okay. Now, that day, you shouldn't be issuing any payments against that until that cheque clears. You assume all checks clear within 3 days. So you've got to be careful about that. Next thing that happens is there's a trust account receipt received on behalf of Fred from Barney, a personal cheque made out to Mulligan Solicitors, $2,000, and various information. So it's another receipt on a different client. So here we've got multiple clients, which firms have. It's another receipt, and that's the total receipts for the month of May. Then you've got a situation where on the 2nd of the 5th, okay, in relation to this Knowles purchase from Mudrake, you receive a letter from Knowles stating that the $600,000 should be placed in an investment account at Southbank Bank, Ipswich, for a period of 1 month on a term deposit paying 10% per annum. Now, this shouldn't be unexpected. If you're a client who's got $600,000, you don't want it sitting in a solicitor's trust account earning no interest. Okay? You want to get it out of there and basically turn it into controlled money, that the solicitor is controlling the money, earning interest for the client, rather than the bank getting in effect, the money free of charge for use in lending out to other people. The thing that you have to watch here is the dates. You've received this letter on the 2nd of the 5th. You only got the check in on the 1st of the 5th, so it hasn't cleared at this point. So what are you going to do? Really, you either wait until it clears or you get a special answer. You get a special clearance on the check. So you pay a bit of extra money and you get it cleared quickly. But one thing is for certain, you can't do anything with this money until it's actually cleared. So you can see there in the actual cash payments book, there's a little asterisk, and you see down here it says, assuming a special clearance was sought on the 1st to the 5th and clearance was advised on the 2nd. Okay. So basically when you're dealing with large amounts of money, you want to get those checks cleared. And then you can take it out of the trust account. So you can see there it's then coming out of the trust account and it's going to Southbank Bank, and it's an investment of the deposit, $600,000. So that's a check going out. So in the trust ledger, we can just zip down to the trust ledger for this particular client. You can see there on the 1st of May, the money's coming in. It's a credit of $600,000. Then it's actually gone out on the 3rd because it takes time for the check to clear through SouthPay. It then becomes a debit. So in effect, there is nothing left in the trust ledger. It's all gone out. And eventually you get it back, including interest. So you get $600,000 plus $5,000 worth of interest eventually in a month's time. Okay, so that's what's happening in the trust ledger. The controlled money movements record, this is the thing that actually records the movement of the money. Now, the example you were asked to prepare wasn't in relation to the $600,000, it was actually in relation to the other client. But the control money movements record, it just shows you where money has gone out, such as in this case an investment of a deposit, interest which is credited back, so there was $50 coming back, and then the payment of it out of the controlled money movements record, so there's nothing left. So what these accounts are doing, what these records are doing, is keeping track of where the money's gone, the interest that's earned on it, and the dates and form in which the dates on which it was paid or received, and the form, whether it's a telegraphic transfer, cash, check, whatever it is. Okay, so basically we've got a whole pile of transactions in relation to 2 clients forming these cash receipts book and the cash payments book. Then you're asked eventually to do a bank reconciliation. Okay, so what the bank reconciliation is doing is that it is comparing the figures that appear in the bank statement against the figures that you've got in your cash receipts and your cash payments books. Because there's going to be situations where there's going to be a difference between the balance in the check account in the bank statement and what your cash book is actually telling you. And those differences arise for several reasons. The most common one is outstanding checks. So outstanding checks, these are checks that you've written that appear in your cash payments book as being essentially paid. So your cash payments book recognises that as a payment, but in fact, because the person that you paid the check to hasn't yet deposited it, it hasn't come out of the bank, your trust bank account. So what it means is that your trust bank account is it's inflated, because it's inflated compared with what your cash books are telling you. And the reason it's overinflated is it's still got money in it that people haven't requested payment on a check. So if they put their check, if they claim payment on that check, it reduces the balance in your bank account, and that balances out to be what it should be. So what you'll see in the bank reconciliation statement is this reference here to outstanding checks. So you can see here that when you get to the end of the particular months we're looking at, end of June, there was one outstanding check that hadn't been deposited by the payee. So it means that the bank account was overstated, in this case, by $50,050. So in order to actually get the bank account to be the correct amount, we have to deduct that check. Because that's what would happen if the payee of the check went along and said, I want the money, here's the check, pay me. It reduces the balance in our bank account. So we have to take it off when we're trying to balance the books. So you start off essentially with the approved ADI statement balance. That comes from your bank statement. So you look at the bank statement which you've been provided, and you look at the date, the 30th of June, and you can see the amount there is how much is it? $655,050. Okay, and then you take off this outstanding check of $50,000. There's no bank charges or anything. See, if a bank charged you something, they have reduced your trust account balance in the bank because they've taken a fee when they shouldn't have, which means that your bank account balance is lower than it should be. So if you see that, you have to correct that error by adding that amount back. So that's why it says add bank charges debited in error. Now, we don't have any in our example, but if we did, you would just put a figure for that error, and you would ring the bank and you say, look, you've stuffed up, you need to pay us back that money. You don't charge fees on a trust account. Okay, that's how you'd handle that sort of situation. So the reconciled cash book balance as at the 30th of June is $605,000. Okay, so that should be equal to what our cash book balance is at the end of June, because it's taken into account all of the things that need to be taken into account to correct the bank statement. So we then look at our cash book balances. So you've got your opening balance in the May, less payments, and these are just the totals. The reason why you do the monthly totals is that these are the figures that get entered into here. These are just monthly totals, the receipts and payments. So for the month of May, you in effect have receipts cancelling out payments, so there's zero balance. That becomes the opening balance in June, zero balance. Add the receipts, take away the payments, and what do you get? The closing cash book balance is $605,000. So what we want to see in a reconciliation is that the reconciled bank account balance will exactly be the same as the closing cash book balance. And you see in our particular case, that's what's happened. So we have what they say, reconciled our accounts. So we have accounted for everything. We know that exactly what the position is in our bank balance, and all of our trust accounting is correct. Okay, if those figures don't balance, it just means that you've made an error somewhere. The places I would be looking would be in relation to checks which are still outstanding. If we can't correct the error based on looking at checks outstanding, then you've made an error somewhere else in your accounts. So that's a much more laborious process, going back and checking. Okay. The other thing is that you need to be aware of is that because trust accounts, if you look across lots of solicitors' firms, add up to millions and millions of dollars, effectively the banks are making a massive windfall gain on all of these amounts of money on which they don't have to pay any interest on. So what's happened is that the Law Society works out, there is a way for us to earn a substantial amount of interest. And the way in which we're going to do that is that we're going to require solicitors' firms to pay a substantial portion of their trust account balances sitting in these banks into an account held by the Law Society. Okay? And that Law Society account will be placed in a bank account or invested so that it earns interest. So there's a whole pile of money essentially being earned. So this is what they call the prescribed account deposit calculations. So what this is a way in which you work out for your particular solicitor's firm how much you have to pay into effectively the Law Society's prescribed account, and how much you keep in your actual trust account with your local bank. So you can see there how you do the calculations. I actually haven't done the figures for this particular problem, but I've set out the procedure for how you do it. Okay, so essentially what's happening, step one is calculate the lowest combined balance of the law practices trust account and the law practice prescribed account at the same time for the previous period ending on the 1st of January. So your particular solicitor's firm, unless it's the first time it's opened up a trust account this particular year, which is not that common, so assuming it's already got a prescribed account balance, what you're looking for is the lowest combined balance of what they've already got in the prescribed account and what they've got sitting in their own trust account. So you look for the lowest balance of that over the 12 months ending on the 1st of January. So that's the first figure. That's the lowest balance according to your bank statements. Add in the prescribed deposit at the date of the lowest balance date. That gives you the total minimum amount that you've got. If that amount is less than $3,000, then you don't have to put anything in the statutory deposit. Okay. Step 2 is to calculate the total minimum account for the next 15-day period. The reason why they do that is that takes into account checks that may have been written that are likely to clear quite quickly. That's why they do that. So you then do this further calculation for 15 banking days after the lowest balance. You work out that. Then step 3 is the amount currently on statutory deposit at today's date. And you then have the minimum amount required to be held on statutory deposit, which you've then worked out, and it's based on 2/3 of the lowest balance. And that just tells you then what you have to do, whether you get money back from the statutory deposit or whether you have to top it up. So that's essentially how it works. It's actually not that difficult to do. It's just a methodical process you go through. Now, just to probably allay your fears a bit, in terms of this online exam quiz thing that's coming up in a couple of weeks, I probably will have some trust accounting questions on it, but they're not going to be complex calculations. Okay, you don't have the time to do complex calculations. But I will have at least a couple of trust accounting things. It might be a question, for example, where I ask you, give you the facts about a receipt, and I might ask you, I might show you a check butt or a check and say, what's wrong with this? And then give you some options that you have to, you might choose what the error is in a multi-choice list, or I might ask you to describe what the problem is. So you do need to be familiar with the really basic stuff about receipts, payments, trust ledger. I'm not going to ask you detailed questions about something like the prescribed balance calculations or give you bank statements and reconciliation, and then you've got to try and nut out some complicated accounting situation. You're not going to get anything like that from me. You don't have the time to do that in a quiz environment. So, okay, so I just want to make sure that you're clear on that particular aspect of it. Okay, I've just about run out of voice. Does anybody have any questions about all of this? It's one of those things you have to go through and do the work until you get it clear in your head. You've got plenty of materials and examples there. The actual manual from the Law Society is quite good. Okay, is there any questions?
Yes, Stephen, it's Louise. Can I just check, the controlled money, is that the same as the investment money account? Like there's controlled money and investment monies?
Well, the controlled money is essentially monies that you have been, as a solicitor's firm, have been provided with to invest on behalf of the client. So the controlled money movements records, it's just keeping track of where those investments have gone. There's a whole lot of other categories. I can't remember them all offhand, but if you have a look in that trust accounting manual, there's other categories of things apart from trust monies. But in our particular example there, it's a controlled money situation because you're controlling it on behalf of the client. They've given you a specific direction as to what's to happen with it, and it doesn't sit in the trust account. It has to be invested, and you have to keep track of it, and that's all we've done. Have a look in that in the Law Society's manual, because it does give you nice, neat examples of the different situations. I'm just at the moment, trying to keep it as simple as possible, which is probably too complex for most people at this stage, and in learning this stuff, because it's quite involved when you haven't seen it before. So I'm trying to, as much as I can, try and keep it at a reasonable level of complexity. Okay, are there any other questions about the accounts we've done tonight?
I'm good.
You good?
Yeah.
It's just sort of famous last words. It's one of those things you just have to go through step by step, and it's pretty methodical. And just go through one line at a time, and make sure you understand how it all fits together. And when you do that, it sort of clicks after a while. If you just look at it as a whole, it's just overwhelming. But that's not the way to approach this. You just do it one step at a time. So say it's a receipt, you look at your receipt, you then look at the trust ledger at the same time and make sure that receipt is recorded in the trust ledger. If it's then a payment, you then make sure that the payment's recorded in the trust ledger. And if you manage the receipts and the payments and the trust ledger, that's pretty much most of the main elements that you need to get by in practice. And make sure you issue receipts properly, and make sure that you issue checks properly, and that you make sure, the really important things, you never issue checks against uncleared funds, and you always check and double check that you've actually got an authority to pay the amount that's sought to be paid, and that you're paying it from the correct trust ledger. And if you achieve those basic things, then 95% of the problems you're likely to have will disappear. Then you start to get into sort of more unusual situations. But if you master that, then you'll be right for most of the things you'll see in practice. Okay. All right, are we right? We've got a little bit over time. If you have any problems, look, don't hesitate to send me an email or ask a question, and we can work our way through it. So, there's plenty of support, and the actual people are contributing quite well on the Moodle side as well, which is good to see. So between us all, we'll be able to nut out any sorts of issues without much problem, I suspect. Okay, all right. Well, if there's no other questions, we might stop at that point. So thanks for coming along this evening. And the rest of the course is actually far less work than week 4. Week 4's got a lot in it, unfortunately. I had to combine a couple of elements of weeks together because I wanted to make some room for the client interviewing exercises, because it's important that you get some experience in managing those types of interviews. So that's why we've got a little bit of a crunch in terms of week 4. But the remaining weeks, there's actually less readings and things to manage. You'll be glad to know. Okay. All right. Well, we'll stop there. I'll just stop the sharing. And what I'll do is I'll end the meeting, and then I'll create the recording. I'll probably have to do it tomorrow because I've got to fiddle around and combine 2 films together because they got split, unfortunately. It'll just take me a bit longer, so I won't get it up there tonight, but I'll certainly have the recording up tomorrow, and I'll post up all of these answers tomorrow morning. Okay? All right.
Thanks, Stephen.
Yep.
Thank you.
Good night, everyone. Okay,
Good
bye.
night.
Thanks, David.
Bye.